Hello and welcome along to the Property Academy podcast. I'm your host, Ed McKnight.
And I'm Andrew Nicol.
And today on the show, we're talking about how to make sure you get the best price in a crazy market. This comes from a long-time listener of the show, Natasha, who said that she is looking to sell her property as a vendor and she wants to make sure that she's getting the right price in what is quite a warm market at the moment. And so she said, how do you steel yourself against the crazy market games so you do get that best price? How much stock do you put in other purchasers' stories or agents' feedback? And how do you actually set a realistic price? And I think this is a really important question, Natasha, because when you're in a market that is changing quickly, it's really hard to know, well, what is a reasonable price? Because the sales that happened 12 months ago don't matter anymore because the market has changed so much.
Even in the last few months, I think the prices that were achieved a few months ago are probably low for a lot of sales that are happening now.
Now, I think what's important to realise is that while anecdotal evidence is important, and it is important, you've also got to look at some wider data to figure out where your property sits along with everything else. But let's talk about anecdotal evidence first. So what people are actually saying. I often think this is important for to get a qualitative sense of how people think the market is going. And then you look at wider data to get that wider sense, because really, market data is just a whole heap of anecdotes put together. Now, what's interesting as well, just while you're listening to anecdotal evidence, is that in the latest survey by the Real Estate Institute of New Zealand and Tony Alexander of real estate agents, 94% of agents said prices were rising in the month of October, and that means that 6% of agents were saying they were either stagnant or falling in their area. Now, I bring that up because if the anecdotes that you're collecting, maybe you get two anecdotes from different real estate agents, and one says prices are going well and the other one's in the 6% saying they're stagnant or falling, then perhaps you're giving more weight to a minority viewpoint if you're only listening to a limited number of people.
And certainly there's probably confirmation bias that becomes true in situations like that. You tend to listen to the stuff that supports the idea that you want. So if you're going to sell your house and two of the agents are saying that the market's hot and going up, or that's what the newspaper says, but there are some articles that contradict that, you're probably more likely to hold a bit of weight. And I guess at the end of the day, something's true if everyone believes it enough and then therefore acts on that belief. So right now, you could pick up any newspaper and see that house prices are going up. Now, because that belief is out there in the market, now when someone goes out to purchase a property, it's highly likely they're doing it with a lot more urgency and they're wanting their offer to stand out. So they may be offering a little bit more or a cleaner offer, or they're making a cash offer, etc.
Now, we are going to look into a comparative market analysis, which is what a real estate agent would use when seeing what a realistic price to list at would be in the market. So a comparative market analysis is when you would look at what has recently sold in the area with similar property. So those of you who like to watch $1 Million Listing or Selling Sunset, that's what they would typically call as the comps. And typically you might see a comparative market analysis come from a company called CoreLogic. But just before we get into that, let's talk more about the emotional side. I wonder, Andrew, are there any stories that you've had where there have been crazy market games, as Natasha calls them, with real estate agents or vendors or buyers playing around in a hot market?
Yeah, I was just thinking back to, as some of the listeners of the show will know, I've been getting rid of all my stock that doesn't meet healthy homes, or maybe the investment in healthy homes isn't going to return me enough of an investment that I think it's worthwhile, so I'm just offloading all that old stock. And so as a result, I've been working through my portfolio quite diligently and looking at stuff that doesn't work. One property, actually it was two properties side by side in Hurley Street, so two townhouses in Central City, Christchurch, that we listed. It was quite funny because we listed it pre-COVID and we had a few offers, and they didn't actually go through to confirmation because these were old houses that had been through earthquakes. And once we did a bit of digging, or once the purchasers did a bit of digging, it turned out the works that we'd had done weren't done to as high a standard as we believed, and so as a result, those contracts fell over. Now, we took those off the market during lockdown, obviously, and once we got back out of lockdown and the market started to heat up, we actually made, I think, about another $50,000 per unit, just because there was that consideration that the market had gone up. And also, one of the other things actually just on that, pre-lockdown, those properties, while they were listed, still had tenants in there, and whilst the tenants' lease was expiring relatively soon, the fact that they were in there and maybe not keeping the house to a standard or the units to a standard that we would have it presented if it was fitted out nicely by an interior decorator, etc., or stager, the amount of offers that we had and the interest that we had was far lesser before lockdown.
Fantastic. So let's jump into what a comparative market analysis usually has within it. And as an example, I've got one in front of me from CoreLogic, and I've used the apartment that I currently rent and live in, which is on Queen Street in the Guardian Trust building, 105 Queen Street. And what's important to note, and the reason we're talking about this, Natasha, as well, is that the only way to steel yourself against a hot market is to figure out what are reasonable prices in the current market. And the only way to do that is to look at what is actually sold, not what's listed on TradeMe, what actually sold with the real prices.
And actually, just one disclaimer I do want to add there is reasonable is whatever you're willing to part with, because if you're going to go and take that money and reinvest, so Hurley Street, getting rid of that, I'm always one to tell people don't sell something, because you only get to sell it once, and the day you sell it, will be the cheapest it'll ever be in the future. But if that money goes to something better, then I was prepared to let it go for the original price, the pre-lockdown price, because who cares? I got the money, I can go and do something else. And so you've got to really set your expectations, or you've got to know what your minimum dollar is before you go through this exercise. And if you don't achieve it, then don't sell it.
And one of the reasons that I've wanted to use Auckland Central as for this comparative market analysis is it's probably one of the only regions in New Zealand or areas in New Zealand that is not having significant appreciation. So at the moment, when you open up a comparative market analysis, what you often see is the sale price versus RV. Now, of course, you've got to take this with a grain of salt, because RVs, or rateable values,
also known as government valuations, if anyone knows about that term,
or council valuations as well, are set by people in office blocks rather than going through the properties, but they're a useful indicator to some degree of how far above those council valuations is the market at the moment. And Auckland Central, and this is Auckland Central West, so a very small part of the Central Business District, is only 3% above rateable values at the moment. And that's partially because there's not a lot of tenants around, and you've still got a lot of investors in Auckland Central. So there's not a lot of demand because the yields are not as strong. There's just not the same level of Airbnbs. There's not the same level of international students there building up tenant demand. But within this, when you look at one of these, you will see property after property after property that is recently sold that is similar. So the property that we're trying to compare against is 60 square metres, 1 bedroom, no car park. Well, I can see that at 6 Dock Street, there was one that sold for $650,000 with a rateable value of $620,000. And you can go through and try and find the ones that are most similar to your property to figure out, well, where does mine kind of sit within this market? The other thing that you'll find really interesting is when you start to look at what are the properties that are on the market which haven't sold yet. And it's actually quite fascinating flicking through to see some of the asking prices that people are looking for. So even though we just said that here in Auckland Central we've got the average property is selling 3% above RV in this instance, you've got somebody in Courthouse Lane, that's the big Metropolis building for anybody in Auckland Central. Somebody is asking for $750,000 with an RV of $630,000. Now, you don't know what sort of renovations might have happened to that property, and it's a 2-bedroom, 51 metre squared property, but I do think that person in particular is going to struggle to sell that property unless they've done something quite amazing to it, especially given that there is another person in that building, 1 bedroom but 48 metres squared, so similar size, selling it for 579.
And actually, just on that, well, I've been working through my portfolio and selling off properties. So some of the properties that I owned, because they'd been through earthquakes and then they had been damaged, they'd had their GV significantly reduced. Now, when I went in and repaired them afterwards, none of the work that I did required a consent, because if you were replacing something or repairing something, it doesn't require a consent. So the council didn't know that those were repaired properties. Now, we didn't let them know because we didn't want our rates to go up. But one thing we did before we sold was had our rates adjusted. Now, I always tell people, look, don't put too much weight on the rateable value. Something could be have an RV of 450 and sell for 650 potentially. But when you're dealing with a lay person that's coming in off the street, there's a good possibility they're going to ask what that is, and they don't have Andrew Nicol in their ear saying, don't worry about it, unless they listen to the podcast. So we went through and we adjusted that, and as a result, that made it easier for people to get higher valuations.
And the last thing that I'll say as well that you will see within a comparative market analysis is the proportion of people in the area that are owner-occupiers versus investors. So in Auckland Central West, there is a significant amount, and I'll just show you the data actually, Andrew, because it's so interesting. A significant amount of people who are investors compared to owner-occupiers. You've got less than 10% of people, I think, slightly over 10% of people who are owner-occupiers in Auckland Central West, whereas you've got almost 60% investors within that suburb, which means that if you are selling your property, in this case, you can get an understanding of who you're potentially selling that property to. So clearly the first thing that we're saying is try and ask for a competitive market analysis. You can get that through Property Guru, or you can ask a real estate agent for it because they have access to that. And then beyond that, you're going to want to be asking your real estate agent who's got some more qualitative understanding or anecdotal understanding of the market a couple of questions. So I'd be asking things like, well, what are some of the properties that have sold recently that are most similar to mine? Now, again, you can get some of that through the comparative market analysis, but you want a little bit more of a story around it. You want to know, what did they list at, and then what did they eventually sell for? And similarly, you're wanting to get an understanding, how much above as a percentage above RV are things selling for at the moment. And then you'll be able to pull it all together and get a sense of, well, what's appropriate right now. And it's important that you're using the most recent sales to form that judgment as well.
Now, next thing is, how do you prepare yourself for sale to get that top dollar? So I made a list of kind of my top tips there. First of all, set your budget. So like I said before, if you're serious about selling, know what your bottom dollar is and be realistic about this, because don't go wasting time and money if your number is completely unrealistic. So set your budget. If it's $850,000 and you're not going to sell any less than that, make that clear when you talk to your agent. And that's my next step. So find a good agent. And I think a big part of this would be a recommendation from someone else, or if you know that there's someone that dominates your market that you're selling in, talk to them. Then there's things you need to do, like maybe updating that RV. Like I said before, if your RV is completely out of skew because you've done cosmetic works and the council don't know, and or you just think it's out of date, contact the council, get that updated. It's a small cost to that, but it's well worth it. You need to think about who you're selling the property to. Now, if you're selling to owner-occupiers and you've got a tenant in there at the moment, or a first-home buyer, and you've got tenants that are in a fixed-term lease, you need to time that. So you need to get rid of those tenants, and you can potentially ask them to leave early and give them a couple of $1,000s, or find them something else if you've got another property, or wait for that lease to end. Then you need to prep your house. So part of that will be just declutter. So if you're living in it at the moment, there's steps that I think we did a podcast on this with Mickey Limmer from Harcourts. Do things like remove all those personal photos and just make it look nice and clean and tidy.
Get the barkeeper's friend out.
Yeah, all those kind of things. And just tidy up the house. If there's just some kind of chip, like a bark chip around the side of the house and it's all over the garden, get rid of that. Just get people in to make it look nice and tidy. I do reports up front. So nowadays what I'll do is I'll provide a building and limb report, even if it's not an auction, so that I know if there's any issues that I haven't considered. Now, there'll be stuff in the building report that I might not do. So it might say, hey, the roof's older. won't need replacing for 5 years, but it's something to be aware of, I'm unlikely to do that. But if it says something like 3 of the windows are sticking, I'll go and fix that because it's cost effective, and then I'll put that evidence in my file. Again, if you're selling to an investor, you may want to think about things like healthy homes. Pay $100 and get a healthy homes report. Show that your house is compliant. Get a meth test. Show that there's no evidence of meth being smoked or cooked in the house. And probably one of the biggest steps that people miss at the moment, talk to your bank, especially if you've got cross security. So if you've got one property, not really that big an issue, but you still might want to find out if there's going to be a break fee of paying off your mortgage early, etc. But if you've got cross security, you need to have that conversation with the bank now, because they might not discharge the property. Now, if you sell a property and the bank won't discharge it because you haven't got enough money for it, then you've got yourself in a problem, particularly with these LVR restrictions coming back in. So if you can't discharge that security at the sale price of $850, you will be in default of your settlement, and that will cost you. So really important you have that conversation.
Let's wrap it up there, but please don't forget to rate, review, and subscribe to the podcast. Really helps us get the message out to more people. And hey, if you're thinking about what you're going to be doing in 2021 and some of the regulations that might be coming in that are going to impact you as an investor, I'm talking debt to income ratios and LVRs, come along to our webinar. It's happening on the 8th of December at 7 p.m. I'm going to drop a link to where you can sign up for that for free in the show notes, or just send us a text. Our number is 5522. If you want the webinar link, I'll send that back to you. Thanks for listening to the Property Academy podcast. I'm your host, Ed McKnight.
And I'm Andrew Nicol.
And we're going to be back again tomorrow with even more daily strategies, tactics, and insights to help you get the most out of the New Zealand property market. Until next time.